Thank you to Blythe and Perry Ann for that very informative fireside chat. Our next panel is titled Banking on the Blockchain, and I'd like to introduce Marc Hochstein, who is the editor-in-chief of the American Banker, who will serve as moderator of this panel. Not sure where he is, but he'll be here soon. Oh, he's getting a microphone. Marc, you've been introduced, and they're
okay.
Ready
Great.
to start.
Great.
It's chilly.
Good afternoon. Before as our panelists come out, I'd just like to take a quick poll, just to get a sense of the composition of the audience here. How many people, a little premature there, sir. How many people here work at a financial institution? That's close to half. How many people work in financial regulation? Good chunk of people. How many people here work in law enforcement? Only a couple of you, but behave anyway. And how many people work in the technology sector? That's a lot of people. Okay, so we've got a good mix, a good crowd. We've got a really interesting mix of perspectives today. Guys, why don't you come out? We are on the panel today. The gentleman directly to my left is John Watts. He's a director at Deloitte. He's going to bring a sort of bird's eye view of what a lot of different clients are doing in this space. To his left is Dominick Paniscotti. Darrius Jones from USAA. He works in enterprise innovation at USAA. And they're doing a lot of really interesting things with fintech in general. To Darrius's left is Bill Hartnett from Citi. He's a managing director there, and he has a deep background in the financial markets. And all the way on the left is Dominick Paniscotti at the NASDAQ, and they've been doing some really interesting work on using blockchain technology to track security ownership. We could have a very sort of pie-in-the-sky conversation about how blockchain can be like a really revolutionary way to track ownership of self-driving cars when we reach the singularity. And maybe we can get to that a little bit later, but since we're here in Washington, D.C., we have a good representation of the regulatory and legal community here. We have a lot of bankers here. Let's start by start the conversation grounded in present realities. I want to ask each of the panelists to talk a little bit about, as you're experimenting with blockchain, as you're testing out this technology, as you're exploring the possibilities here, what kind of feedback have you received so far from the regulators about this technology and about a financial institution being involved? Start with Darrius.
So I think, my peers on the panel would agree with me. We haven't gotten a lot of specific feedback, right? We've been really focused on the identity piece on blockchain and, more importantly, what constitutes ownership. And there are varying opinions depending on which organization you actually speak to. I look at it personally, and it's an opportunity for our organization to combine those two concepts, but it's still, as we had our conversation in the green room, does not change what identity is versus what ownership is.
Bill.
Most of the feedback we get from regulators is really more questions than direction, right? So they're just as curious as everyone else is in the audience here about what does this mean. We had recently had a conversation with the gentleman from the SEC, and I think they're at a point where they want us to help them. What are the right questions to ask, right? So we know that from a Fed perspective in the foreign exchange markets, they've said that, look, any new type of technology that is used in the foreign exchange market has to guarantee finality of settlement. So then the question is what does that mean in this new kind of blockchain world? When does transfer of ownership actually take place? Is it when I put the transaction out on the network for confirmation by the rest of the network? Is it when it actually gets written? What happens in a stress situation? So let's say we were operating in the environment back in 2008, and one of the counterparties that puts a trade out there is Lehman Brothers. What's my liability as a participant in that network for verifying that transaction, that that's a really good transaction? And do I even want to if I'm seeing that I'm a net creditor to a party that looks like they're going bankrupt? So there's some very big questions from a legal and regulatory perspective that have to be answered.
Dominick, what kind of feedback has the NASDAQ received on regulation, from
Well,
regulators rather?
Well, I mean, we're a self-regulated organization, so we start there. So really a lot of what's going on is, I think I'll echo what some of the other panelists are saying, is that we're getting a lot of questions. And to that end, we've actually gone out and done a lot of education. So we're out at the regulators fairly frequently, discussing with them this technology, the disruption that it can have, the opportunities, that can be availed, in using this technology. So I think it's really about education at this point, to be honest, more so than the regulators coming down and asking us in particular about any one aspect or kind of cracking the whip in any particular way about this technology. To that end, we've been very focused on working on particular projects that are kind of not in highly regulated areas. So, we built some products that manage private securities. We're doing some work in Europe and Estonia with proxy voting, for example. So these are all great means by which to actually show this technology working, and to that end being able to educate people about what it is. The fear factor starts to then fall off.
And John, you talk to a lot of different institutions. What are your clients hearing out of Washington about this?
Well, it is interesting. I think we're seeing, a positive pattern. I think, when cryptocurrency really first hit sort of I can't ever say it really hit the full mainstream, but when it, really came a sort of awareness of it, globally, you saw reactions by, regulators from across, different jurisdictions, sort of rushing out, trying to, make declarations about, whether this was positive or negative. In some cases, actually taking regulatory action to ban or restrict usage. We did some of those kinds of things in the United States. What I think is positive now is that, for sort of, as we move and start talking more about the blockchain aspect about this, there's now a more measured approach, and this is happening globally. So the pattern that my panelists are talking about, regulators wanting to ask questions, to learn more about it, I think that's absolutely right. And there is, I think I'm starting to see some element of, commercial policy, commercial strategy amongst different countries, sort of recognizing, as some of our earlier folks have talked about, this is Internet 2.0, if you will. And so there's definitely a move to begin to think about, well, how do we create the right, policy and regulatory environment to allow this, technology to grow and prosper within our jurisdictions. And so I do see a more cautious approach, and I think there's more of an eye to creating some stability, around the environment, which is, ultimately what some of the startups are really looking for in terms of their ability to succeed. So moving in the right direction, but there's a tremendous number of questions that still need to be answered.
If we can drill down a little bit, Bill, talk about when you're looking at the potential of blockchain technology and you're hearing pitches from these various software providers, what are the problems that you need to solve that potentially could be addressed by this type of software?
Well, as you've heard most of the day, there's any number of ways that you can utilize technology. I think ultimately, as we've gone through this process over the last couple of years, we started to ask a question early on is, do we have a technology problem or do we have a process problem? So by and large, right, we've done a pretty decent job in financial markets of automating processes that were developed 40 or 50 years ago. $5 trillion a day goes through the global foreign exchange markets. Hundreds of millions of transactions go through every day in the world's equity markets. Now, that being said, these processes were designed, like I said, 40 or 50 years ago, where you needed 2 days to settle, or you needed 3 days to settle some. So that the opportunity, we think, is really is kind of 3 areas specifically for banks. It's managing capital, right? So if I have shorter settlement times, I can decrease the amount of capital I have against outstanding positions. It comes down to managing liquidity, which is closely associated with that. And then lastly, it's about managing operational risk.
Elaborate on the op risk part.
So to the extent that you're using systems that are older and designed for other processes, one of the questions that a lot of our senior guys ask is, if we were starting this market today, would we design this process that we have today? Ideally not. So operational risk is really when something goes wrong, where was the mistake, right? So if you talk to our direct clearing custody people, 97% of those transactions are fully automated and STP'd. 3% have issues. One of the challenges we think for any blockchain implementation is how do we manage what our technologists call that semantic layer, right? A lot of the trade breaks occur for simple reasons because in one data field, I put 1, 2, 3, and you put 1 space, 2 space, 3, and the systems don't speak to one another very well. It's not clear, at least so far to us, that blockchain addresses that particular issue from a trade processing perspective. So
That's basic standardization. That's what we have Swift for, right?
Swift is only, that's the beauty of what Swift did, is they created a common language that says, if you want to send a security from point A to point B, this is the message that you use. That only covers a small portion of the overall marketplace.
Dominick, talk about why NASDAQ has been using blockchain for private securities. You've already got an electronic exchange. It's pretty modern, compared to other exchanges out there. What do you need this stuff for?
Sure. So I'll take you back to, I guess, Adam Ludwin from Chain did a great presentation here earlier where he took a 20 out of his pocket, handed it to somebody in the audience, and transferred some assets immediately. And he talked about it. Oh, by the way, Adam, stop sending out 20s. We're an investor in Chain, so every time you come to one of these conferences, like, hold on to your money and use it to actually build blockchain stuff. But anyway, but I think generally speaking, that's exactly why we're interested. I think if you look at the Satoshi paper and you take a step back, it wasn't about building a digital currency. Maybe that's what the paper says. But at some level, what happened is he created a digital bearer instrument, and that had never been seen on the planet, generally speaking, right? So we had never seen that. And what is it that a stock exchange does all day, for all intents and purposes, is moves a couple of digital bearer assets around from point to point, which is some securitized instrument from one individual to another, and some currency from that individual back to the seller. So that's why we're interested. Now, certainly stock exchanges these days run in microseconds, as you all kind of know and read the paper. So the technology doesn't work in microseconds. So we don't think it's about information discovery, price discovery, right? We don't think it's about the order, the buying and the selling part. We think it's actually about the recording of the buying and selling. And because it's the recording of the buying and selling, it's actually important from both a post-trade and a pre-trade perspective. So from a post-trade perspective, any exhaust that comes off a stock exchange or a dark pool or wherever it goes, today goes to the information processors, and those trades are recorded in perpetuity. That's what you would put on the blockchain. It would simply represent the change in ownership of those digital bearer instruments. That's post-trade. Why is it important from a pre-trade perspective? Well, if you don't have the assets to sell or the assets to buy, you can't place a trade on a stock exchange. So really what our CEO likes going around saying is kind of like a step backwards to some degree. We're going back to an era, he likes to say the 1600s. I'll move it up a little bit and say it's kind of like sitting in front of the buttonwood tree down on Wall Street when somebody showed up with some dollars and some stock certificates, exchanged them in the middle of the street in an open outcry. It's not unlike that, except in a digital representation of that. And it can occur at very high speed. And when it's done, it's done. The transaction is done. So I think that's why NASDAQ is interested. That's what's disruptive about this technology from NASDAQ's perspective, and why we think it's disruptive to the capital markets, just generally speaking. And you'll see we've done a few experiments along those lines.
So you have the hand-to-hand transfer of the buttonwood tree, but the parties don't actually have to physically be next to each other.
So it's that peer-to-peer aspect that's quite important, right? So those peers are well known, and you can come back to the identity and the ownership aspects. Certainly, the blockchain can also manage identity as well. So you can put on the blockchain information, people's birth certificates or driver's license information, things like that, and associate that with a particular owner of asset. But I mean, imagine a day when you can trade, Google for Apple share, or Google for any other asset that you have in your wallet, for example. Fractional ownership in some condominium, for example. Anything along those lines. You'd see all this information kind of in a single area, and you would be the owner of those assets because they happen to be associated with your identification.
Darrius, can you talk a little bit more about this work on identity that USAA is doing?
When you think of some of the fractional ownership positions that you spoke about, there's a very specific transaction that has to happen in order for us to establish fractional ownership of something, say, like a car or a house. You have to refinance to put someone on those assets typically. This really represents an opportunity for us to shift from refinancing to just adding an additional resource or identity to a given asset. And we have a unique situation given the constituency that we support, the U.S. military and their dependents. They're extremely transient, and they have unique living situations, which really makes that extremely important. And so for us, identity and ownership are things that need to be combined in order for us to create solutions that are relevant for that particular marketplace.
Walk us through an example, a USAA member, a problem that they have today that this combination of identity and ownership would make things easier in the future.
So today, we're deployed in a base, and I own a vehicle, and you contribute to it. So you don't actually own the vehicle. Typically, you're not my partner in this case. And so, how do you facilitate that? And that's a request that we get often, which is, hey, I want to own that vehicle with that person for 6 months, and then I want to go and transition into another vehicle pool at some later time. Even housing, right? Off-base housing, you see that a lot. You see people purchase together a particular facility or multifamily dwelling. They move to another base. They want to relinquish their ownership in that, and that's a very difficult transaction for A, to sustain, because you have to go and refinance and go through the whole sale process again, or it's legally a straining opportunity. And so we see this as an opportunity to create a different type of marketplace for housing, auto, insurance, you name it.
Before we came out on stage, we were having a really interesting conversation, very almost philosophical conversation about ownership. One of the really interesting and brilliant things about Bitcoin is that it reifies the concept of ownership. Ownership in Bitcoin is not just based on social norms. It's based on control of a private key. And so it takes this sort of abstract notion of ownership and it makes it something closer to physical reality, at least in that system. But John, what does that mean when we take this technology away from just this sort of internet money, and we're dealing with lack of a better term, real world assets?
Yeah, so I think that's the question facing the entire industry. And we're going through a period where everybody's trying to figure out, what are the use cases for this? And there's, we're trying to do it internally within Deloitte. Every firm has some aspect of a new bank, old bank, trying to work on this. There's, underground movements within firms. People trying to work through what does it actually mean? How do we, going beyond just the cryptocurrency aspect of this, how do we actually apply this to our business? How do we change our business? How do we disrupt our own business? And I think the challenge that we're seeing, what we're the kind of question we're asking ourselves now every time when you start to figure out, is there really a use case? Is there a reason for applying this technology to a question? Is asking yourself, if you replace the word blockchain, with the word database, is there anything that the business case you're trying to develop that wouldn't be relevant if you just were leveraging a database? And so I think we're going to see happening is a lot of startups, a lot of institutions, working through this notion of, well, what are the real use cases? And I think in the end, it's going to come down to, it is almost that Bitcoin, original Bitcoin use case. There's got to be something around the transfer of ownership. There's got to be, the need for immutability, the ability to have trust to make sure that record, can't be tampered with or changed afterwards. And there needs to be this peer-to-peer aspect to the problem, right? So the more we sort of consolidate and focus on use cases that bring those elements together to solve problems, I think the faster we're going to start to see, solutions that are going to start to take hold in the marketplace. But I think there's going to be a lot of confusion along the way as, people try to distinguish between this and traditional technologies we already have.
I'm glad you mentioned the whole why not just use a database question, because I want to put that out to the three financial institution representatives that we have here. Bill, are these blockchain solutions that everyone's talking about, what can they bring that just a SQL database doesn't bring?
Well, I'm not a technologist, so I'm not going to attempt to answer that question from that perspective. But when we look at this it was actually a conversation I had with Adam Ludwin several months ago, that I kind of had my aha moment on this stuff. He said that the real power in blockchain technology is the actual data structure itself. The fact that you have a chain of blocks of information, that you can see the provenance or the lineage around a particular asset or any other type of process, that's the real power to this, right? And so when we've looked at this and we break it down, you say, okay, well, typically we think of a database, at least on the business side, as a type of Excel spreadsheet where you only see the latest snapshot of a process, and then you have to go and query other aspects to try to find out how it got to that position. But if you think about the components that make up a blockchain, where you have this lineage of data, the use of encryption, and in terms of storing the data, especially in a world where information security is becoming increasingly fraught, the idea of using multi-sig public-private keys, not just in the transfer of ownership, but think about this in terms of the process. So in order to affect a payment, I have to sign with my key, Dom has to sign with his key before it goes out, right? So there's some real interesting things that you can start to do with that sort of technology from an operational risk perspective. And so it's that combination of those things, the idea of using a hashing function to prove immutability, that what I have, a question you could get from an auditor is, how can you tell me that this trade that you have in your data hasn't been changed from the day that you traded it? Easy, you run it through a hashing function, you compare that hash with the hash that's stored on blockchain, and if they match, there's been no changes to it.
That's a really good explanation. That's like, so it's more than a database. It's almost like it's a county clerk's office and PKI combined.
Well, I think don't let anybody fool you. It is a database. I mean, that's what's funny about it. It's a federated database. And I think to the point that was just made, it's really about the data that's stored in that federated database that's important, and the structure of that data. And so the database aspects are kind of the not important piece of the puzzle, if you will, right? Like, there have been federated databases, they existed. People could have built this blockchain structure on top of those databases in the past. They simply didn't. And now what we have is a technology that basically resolves both problems. It resolves the high assurance problem, kind of from a Byzantine fault tolerance perspective, right? So the system is completely fault tolerant. It's an immutable database. Like, all of those things are what makes it important, to our industry. But again, don't let anybody tell you it's not a database, because it certainly is.
We're going through a migration, totally unrelated, from traditional file sharing to kind of, Dropbox box type technologies. And, I had a conversation with one of my coworkers on, how come you're not doing version control? And I said, what are you talking about? And they're like, well, where's your 7 different versions of the file, 1.1, 1.2 through 1.7? And I really look at that as the same kind of analogy, right? The CEO of Chain said it best, to move without copying is really a powerful function when you look at it in aggregate, which is something that as an industry we've kind of been missing. We can replicate copies of anything that we want. Which copies are right? And so some of the business changes that we're trying to enact specifically on the consumer lending side really requires that kind of finality and moving without copying and knowing which copy is the actual true version of the truth.
We'll open it up to questions in a minute. I think one thing I guess is sort of inevitable is the whole private versus public question. Using a private blockchain built for purpose, built for use, versus using the granddaddy of blockchains. What are the relative merits and drawbacks? We'll start, Darrius.
Wow, that's a very heated internal debate at the moment. My buddies in InfoSec really appreciate having a private blockchain. And I don't think we can clearly articulate why. It's comfort. And I wish it was something more than that, but essentially it's a comfort space at this point. People do not feel comfortable having certain transactions on a public ledger. And until we prove otherwise, I don't know anyone else who works at a financial services company, but it's usually hard to win against the InfoSec guys.
What's the other side of the argument?
The other side is convenience, right? Metcalfe's law at work, right? The network is directly, the value is directly established by the number of nodes on the network. And so that's the argument. The more nodes on the network, the more valuable the network. And that's an argument that you can't really argue against either. But in our firm, security wins.
Dominick?
I think Vitalik gave actually quite a good explanation earlier about public versus, first of all, I hate public versus private versus federations. Like, to me, it's kind of like there's this thing called the blockchain, and there's a certain set of people who can access it. That certain set might be the entirety of the open internet. We call that a public blockchain. Having a subset of just a few banks might be a private blockchain, or just one entity like NASDAQ might be, private blockchain. So I think the whole concept of public versus private is a function of access rather than anything special about the particular blockchain, right? But I think
versus permissionless, is that a better taxonomy?
I don't know. Me, as a technologist, I simply, I think the person from Microsoft, I didn't get his name, but who's on the panel earlier said the same kind of thing. It's kind of like the intranet versus the internet, right? We don't treat them any differently from a technology perspective. They run exactly the same technology, but yet they're bounded kind of by access in a different way. And so I'm not even sure I like that per se. But I think really what private blockchains, if we're going to use that terminology, allow you to do is they allow you to do things that you can't do on the public network, whereas on the public network, you've implemented particular features like Vitalik mentioned earlier to secure that on this very public open internet. You don't need to implement those features in a closed system, and therefore you can gain efficiencies that otherwise you don't have the ability to gain on the public internet, in a closed system. So I think when you look at these technologies, you have to look at it very much that way, rather than kind of having this I think the debate about public versus private is a bit overdone, in my opinion.
Well, I still would like to hear, Bill, Bitcoin versus Blythe chain, your thoughts?
As a bank that has pretty heavy responsibilities from an AML KYC perspective, until we can solve and answer those questions from an open pseudonymous network versus a closed private permission network, I think it's an easier sell to try to take advantage of the technology in terms of a closed private network or permission network. There's also I think part of this is not just those sorts of things, but the Bitcoin is a very elegant solution that solves one problem and one problem only: the transfer of value in an open, trustless network. And it's a very elegant solution for that. However, it's probably not the most efficient trade processing system ever designed. recently read an interesting article on one of the blogs that follows this stuff, and they were heralding the amount of computational capability that exists in the Bitcoin network. It's something like 50 to 100 times the entire processing capability that rests in all of Google. Computational power. That's to manage 200,000 transactions per day. So
A lot of electricity.
There's another blog which is kind of interesting if you think about it, is that calculated, I don't know if this is accurate, but he calculated that the average electricity used to verify one Bitcoin transaction can power the average household in the US for a day and a half. So it's an elegant solution, but it's not really the most efficient solution. So I think ultimately what we see that gets more broadly adopted within the marketplace is some evolution of the technologies that we're working with today.
Just to comment on this too. I think there's a real debate. And I think part of the way you answer that is from the perspective that you're coming from, right? And so I think you heard it from our panelists that, are actually, in business, in the financial services industry. There's a number of things about truly, public blockchain-oriented solutions that make the industry and regulators, very, very nervous. I would probably say too that there are, roles within traditional financial services organizations where there's money being made providing some of those intermediary type, functions and services that the folks that are arguing very strongly on the sort of the Bitcoin blockchain approach, they're looking ways to see, well, how do I actually disintermediate some of those functions? The notion of how inefficient the blockchain is, absolutely, but that reflects sort of the cost of trying to, do something or change the network, when you shouldn't be. That's a powerful idea. There may be more efficient ways to do it, but there is that notion of, being truly decentralized and having the ability to make sure that's absolutely secure. That's a powerful concept. And so, I don't think I think, we talked about a sort of a continuum on this. I think there's absolutely a continuum. And I think, partly what you're going to see is, it's depending on what problem people are trying to solve and whether they're taking an evolutionary or disruptive approach. You need to ask that question to understand where an organization might be coming in terms of the way that they're arguing on this particular debate.
Yes, I'd like to make one comment. I read the same blog I think you did about the 100 times the power of Google. I think the one thing that needs to be said, though, is that the economics of Bitcoin continue to work regardless of the amount of electricity that's being spent on it. That is, those miners pay that electricity because the net, from a net perspective, they're still profiting from the mining of those coins. So the economics of Bitcoins works. When the economics of Bitcoin stops working, then Bitcoin may not be the value store that it is today. But at this point, while those economics continue to work, and there's no reason to believe they won't continue to work for the foreseeable future, it's a solid place to store value. Now, that being said, could you do it more efficiently in a private environment? Surely, but it does what it does quite well.
Questions?
Sure. Hi, Steve Beauregard with GoCoin. Perhaps the title of this got me wondering, worrying about banking. So our company's gone through, with the Digital Chamber, we went through a workshop, 3-day workshop that was led by some top attorneys in the space, built a very comprehensive compliance program. We still work with Pillsbury and so forth, yet I'm not sure if it's because we have coin in the name GoCoin, we still can't get U.S. banking. And so I'd like to know from the panel, is it just because the name Bit or Coin is in the company name? It's not even that they're looking at our compliance program. So I just would love to hear from the panel, what is it going to take for a tier 1 company to be able to use tier 1 banks in the U.S. for Bitcoin and not have to park a couple $1 million in the account?
It's a great question.
I know everyone's looking at me, but
Yield to the banker.
Well,
my area of expertise is in markets and security services, so I can't really comment on the payments aspect of that. So sorry, I can can put you in touch with some people if you want.
Darius?
And not that I'm going to punt, but we don't do commercial, so.
Okay. I suspect that it, well, I mean, it's almost certainly relates to the AML KYC questions that Bill brought up earlier. John, do you want to tackle this since you have a pretty good perspective on things?
At the dinner we were at last night, we got into a conversation around, I'd sort of talked about it before, some of the, original concerns when Bitcoin really first hit the scene. And there was so much negative press around it that in some ways the industry and anybody that has a coin or a bit in their title is I think, still probably suffering, from some of those perspectives. And it's easy to understand why regulators, when most of the information they probably heard about this comes from, the negative press, because most of the press in the cryptocurrency space has been negative. You're starting to see some turn of that now. But, I think it's a question of the industry starting to figure out how to sort of rebrand themselves, communicate themselves in a different way, working to change some of the mindsets, and then ultimately, getting beyond that and beginning to engage on, what we really have versus sort of the perceptions that we have. And AML, KYC, and the concerns about money laundering, those are huge problems. And so, anything that's with a bit on it at this point that you try to bring that up, it's difficult.
I think the challenge is it sounds like the fear is greater than the actual risk. And so I think it's going to take some education and dialogue and getting to know a company like yours and starting to get a little bit more comfortable a little bit at a time.
Other questions?
Any aspect that banks would not want to work with fintech startups because they don't want, they view it as a threat, they don't want the competition, they want to sort of keep the industry down? Is there any aspect of it to that?
There may be elements of that in the banking system, but I can tell you that's part of my job in the firm is to take advantage of those types of innovations that are coming along. So it's about getting in front. To borrow the famous Wayne Gretzky phrase, is to skate to where the puck is going to be. And, I know at the very highest levels of our firm, I spent 2 hours with our CEO and one of our board members in December getting them up to speed on what we're doing in the blockchain space, both. And I had my counterparts in the cash management side of the business as were part of that meeting as well. And so there are some dinosaurs out on the trading desks, right? So I'd like to call it the TTR problem. That means time to retirement. So, so that the guys who are going to retire in 6 months, they don't really care. The guys who are going to retire in 2 or 3, they do care because they want to kind of maintain that gravy train. But the people that have 5, 10, 15-year time horizons on their business are very much on top of this stuff and really looking at it. For example, I know that Citi, our securitization business, is one of the largest buyers of loans from Prosper.
Yeah, I think a slight different view on that. It's an interesting question. You've got to remember too that you're dealing with banks, right? And so banks are in the business of trying to make money. So one of our clients, heavily invested, in both the cryptocurrency aspect and the blockchain aspects of what's happening. But they they really only want to deal with companies that they've actually made an investment in, right? And so, there is that aspect of, sounds great, but how are we going to participate and benefit from the value that might get created? And I think that question is actually, more front and center when dealing with the existing financial services industry than it was, talking back in the internet boom. I think there's an aspect of, we know there's going to be tons of value created here, so tell me how we're going to participate in that.
Just to close
Not
out,
just buy it.
we've had more open conversations around this subject than I think any subject that's kind of come prior. So as far as collaboration between organizations, this is one I think we're fairly open about and highly collaborative.
One more question, sir.
I'll echo the concerns of my friend at GoCoin. As Bill Schaefer, we have a non-custodial cryptocurrency wallet. I'm on my 4th bank. And what I'm finding is that early on we were
encouraged to register with FinCEN, which we did. I have a chief compliance officer formerly at the CFTC and the SEC. But I don't even get to have the conversation, because what happens is, because I'm registered with FinCEN, I'm an MSB, right? And so now I'm thrown into the Operation Choke Point cesspool. I don't even get to have the conversation about digital currency. And so it's almost like a poison chalice here. Yes, register with FinCEN, do it right, but banks are shutting down the MSBs. And so what we're finding is, we help people send money around the world, but what we're doing is we're selling a thing. So I don't, as an MSB versus an money transfer operator, I don't have to prove who's getting it. I'm just selling you some gold or whatever, and what you do with it is your business. And because we're non-custodial, I'm out of that transaction. So we actually reduce the AML KYC compliance responsibilities from the financial institutions. But again, that's kind of the experience that we're having. So if I can help engage in a conversation with banks, if you can't go from fiat currency to digital currency, you choke off the whole thing. So.
Well, I think you have a point there. Some of the comments I made earlier around sort of the growing realization that this is from a jurisdictional perspective, this is a commercial policy decision that will have impact on who captures what value where. There are challenges in the U.S. and there are other parts of the world where those challenges aren't there or aren't as acute. And just the 10,000-foot view that we have at Deloitte is that we're seeing a lot of companies that otherwise would start in the U.S. actually move to different jurisdictions for reasons that you're talking about. And so I think this forum here today is incredibly important in terms of actually raising those kinds of issues and getting them to the table, because it is a very fine line between regulating and then potentially choking off or stopping innovation that is going to be beneficial to the entire industry.
Good thing that we're having this conversation here in Washington. Absolutely. I think we have to put a bookmark in the conversation, though. But I want to thank, this has been a fascinating panel. I want to thank everyone for participating. Good questions. Thank you very much.